Your Centrelink payment just went up. So why does your bank account feel emptier than ever? That is the question nobody warns you about. And if you've recently lost your partner, or you're worried about what would happen if you did, the answer matters more than almost anything else in your financial life right now, because the number Centrelink sends you can go up, and your actual living situation can still feel like a step backwards. That gap between what the letter says and what life actually costs is what we're unpacking today. I'm Paul. And before we go any further, I want you to take a breath. This video is not here to frighten you. It's here to give you the clear picture that Centrelink's letters often don't. By the end of this, you'll know exactly what changes when a partner passes away, why the so-called single rate can still catch people off guard, and the specific numbers you need to check so you're not left scrambling when you're already going through one of the hardest seasons of your life. Here's what we'll cover. First, we'll walk through what actually happens inside the Centrelink system when your status changes from couple to single. Then we'll look at why so many people assume they'll be better off financially, and where that assumption falls apart. And finally, I'll give you the 3 things you need to check and the practical steps to make sure you're not leaving money on the table or running into a shock you didn't see coming. Right, let's get into it. When your partner passes away, Centrelink stops assessing you as part of a couple. That sounds straightforward enough. You were 2 people. Now you're 1. So the system treats you accordingly. What that means in practice is that your age pension is recalculated under what's called the single rate. And yes, the single rate for the age pension is higher than the per-person rate that each member of a couple receives. A couple, combined, gets less than 2 singles would, so on paper, your individual payment goes up. And that's the part people tend to focus on. The number in the letter is bigger. So surely that's a good thing? Here's where it gets complicated, and this is the bit most people don't see coming until they're already living it. When you were part of a couple, there were 2 payments coming into the household. 2 Medicare cards, 2 sets of concessions, 2 lots of whatever supplements or allowances applied. Rent assistance, if you were renting, was calculated on a shared basis. Utilities, groceries, insurance. All of those costs were being split across 2 people, even if they didn't feel like it at the time. 2 people living together cost less than twice what 1 person living alone costs. That's just the economics of a shared life. When your partner passes away, you lose their payment entirely. Their age pension, their supplements, any income they were contributing, whether that was from superannuation, a part pension, or anything else. All of that stops, and your single rate payment, even though it's higher than your share of the couple rate, is now covering a household that still has a lot of the same fixed costs. The rent or mortgage doesn't halve, the electricity bill doesn't halve, the rates, the insurance, the phone plan you've had for 20 years, none of that adjusts automatically just because there's 1 fewer person in the house. So the gap between what people expect and what they actually experience can be genuinely jarring. And that surprise, arriving at the worst possible time, is exactly what we're trying to prevent. Now, there's a myth I want to deal with directly, because I hear it constantly and it causes real harm. The myth goes like this. Once you're assessed as a single, the income test and assets test become more lenient, so surely the pension pressure eases up. And it's true that the thresholds do change. But the mistake people make is looking at that in isolation, without accounting for the fact that the assets and income that were previously split across 2 people are now assessed against 1 person's thresholds. If your late partner had superannuation that's now coming to you as a death benefit, or if you've inherited assets that push your total above a new threshold, the picture can actually become more complicated, not simpler. More assets in your name, assessed under single thresholds, can reduce your payment in ways you did not see coming. And that hits at exactly the moment when you're least equipped to deal with a financial surprise. So the things you need to have on your radar before any of the panic sets in are these: the combined household income you were living on as a couple, what your new single rate payment actually is, what assets are now in your name, and how they sit against the current single thresholds, and whether there are supplements, concessions, or entitlements that change when your status changes. Those are the moving parts. And they're the ones we're going to work through together in the next section with real numbers and a clear 3-step framework you can actually use. One more thing before we move on, and I mean this genuinely. Everything in this video is general information. I'm not your financial advisor, and I'm not your Centrelink caseworker. Your situation has its own details, its own history, its own numbers. So please do check with Centrelink directly or sit down with a licensed financial advisor who works with retirees. What I can do is give you the framework and the vocabulary so that when you have those conversations, you're not walking in blind. Right, let's look at the actual numbers, the mistake most widows make, and what you can do about it. Let me introduce you to Margaret. She's 72, lives in a modest home she owns outright in regional New South Wales, and she's just lost her husband Ron after 48 years of marriage. She's not alone in this situation, and the numbers I'm about to walk you through are ones I see come up again and again. When Ron was alive, the household was receiving the couple rate age pension. Combined, they were getting roughly $1,700 a fortnight, each of them receiving their share. Ron also had a small superannuation account paying him $200 a fortnight as an income stream, so the household was running on around $1,900 a fortnight in total, enough to cover the bills, keep the car on the road, and have a little left over. Ron passes away. Margaret notifies Centrelink. She moves to the single rate, and the letter arrives confirming her new fortnightly payment is around $1,150, higher than her share of the couple rate. She reads that number and feels a small wave of relief. It went up. She thinks she'll be okay. But here's what the letter doesn't spell out. The household went from $1,900 a fortnight to $1,150. That's a drop of $750 every 2 weeks. And the electricity bill didn't change, the home insurance didn't change, the council rates didn't change. The grocery run is a little smaller, sure, but Margaret is still heating the same house, running the same fridge, paying the same internet provider. That $750 fortnightly gap is the single rate shock, not the rate going up, the total household income going down, and Margaret was not prepared for it because she was looking at the wrong number. That is the mistake most widows make. They focus on the headline single rate, see it's higher than their couple share, and assume the system has been kind to them. It has been, relatively speaking. But the comparison that matters isn't your new rate versus your old share. It's your new household income versus your old household income. And that number almost always drops, sometimes sharply. Now, here's where it can get harder still. Ron's superannuation death benefit, let's say it was worth $80,000, comes to Margaret as a lump sum. She now owns a home plus $80,000 in assessed financial assets. Under the single assets test, the full pension threshold is currently around $295,500 for a homeowner. She's well within that. But if Ron had more superannuation, or if there were other assets, that balance shifts quickly. More assets assessed against one person's threshold, not two. That's when payments start to reduce, and that's when people ring Centrelink confused and a little frightened, wondering why their pension is going down at the same time everything feels harder. So, 3 steps. Let's make this practical. Step 1. Get the real household income number, not the rate number. Before you do anything else, sit down and write out what actually came into the household each fortnight when your partner was alive. Every source, both age pension payments, any superannuation income streams, any other regular income. Add it all up, then write down your new single rate payment. The gap between those two figures is the actual change in your financial position. That is the number you need to plan around, not the rate comparison Centrelink's letter implies. Step 2. Check where your assets now sit against the single thresholds. This is the check most people skip, and it's the one that can bite hardest. If you've inherited superannuation, received a death benefit payout, or had assets that were previously in your partner's name come to you, your total assessed assets have changed. Log into your MyGov account or call Centrelink directly and ask them to walk you through your current assets assessment under the single rate rules. You want to know exactly where you sit relative to the thresholds. Are you below the full pension cut-off? In the taper zone? Close to a threshold that could shift your payment? Get that number clearly. It takes one phone call and it changes everything about how you plan the next 12 months. Step 3. Review your supplements and concessions. Your pensioner concession card, your energy supplements, your telephone allowance if it applies, and any rent assistance if you're renting. Some of these adjust automatically when your status changes. Some require you to notify Centrelink separately. Don't assume the system has updated everything on its own. Ask specifically whether all supplements have been recalculated under your new single status. A missed supplement isn't a disaster, but it's money that belongs in your account, and it adds up over time. Now, a word before we close this out, and I say this with genuine warmth. Everything I've walked you through today is general information. Margaret is a hypothetical. The figures I've used are indicative and based on publicly available information. But your situation has its own details, its own asset mix, its own history. Please do contact Centrelink directly to understand your specific assessment. And if the numbers feel complicated, a financial advisor who specialises in retirement and Centrelink can sit with your actual figures and make sure nothing is being missed. You don't have to navigate this alone. Here's the recap. The single rate goes up, the household income goes down. Those two things are both true at the same time, and that's the thing the letter doesn't say out loud. Margaret's payment increased. Her fortnightly income dropped by $750. She was looking at the right letter and the wrong number. The 3 things that matter most are your actual household income gap, your updated assets position against single thresholds, and your supplement and concession entitlements under your new status. Get those 3 right, and you won't be caught off guard. If this has been useful, subscribe. I put a new video out every week helping Australians in and around retirement cut through the Centrelink noise and understand their actual numbers. And if you're going through this right now, or helping someone who is, leave a comment below. I read them all, and sometimes the questions you ask become the next video. I'll see you in the next one.